Welcome to the Pirls Stock Market Commentary video featuring the proprietary Bull Bear Point and Figure Market Breadth Summary Chart for January 1st, 2017. Market breadth. With this past week's market decline, our Bull Bear Point and Figure ratio at 1.58 rose from 1.28 last week, advancing within bullish territory. The total count of securities in bullish or bearish patterns decreased 3% to 3,218. The count of bearish stocks decreased 14%, while the count of stocks in bullish patterns increased 6%. The Sand to Pearls PNF Market Breadth Summary Chart shows us a market now 7 weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the weekly Sand to Pearls Stock Market Commentary via email, free of charge, simply enter your email address in the space provided and click Subscribe. The well-known Market Breadth Summary Chart, the Nasdaq McClellan Summation Index, fell 52 points for the second decline in 20 weeks. At a positive 355.42 points, it continues above the November 2014 and March 2015 tops, has created a new December 2016 top, and continues below the remaining two tops above plus 100, as well as continuing above all 6 bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in distribution mode, with average daily volume lower than the prior week. In the last 2 weeks, the Nasdaq had 1 accumulation day and 3 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode on lower average daily volume. Momentum. After last week's successful trade, now with 1 day below zero, at a negative 30.87, the CCI 20 is down from a positive 62.06 a week ago and is within the plus or minus 50 range for a valid zero-line reject entry signal if the CCI 20 rises. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 35 weeks ago, while the daily CCI 20 began a Woody's uptrend 6 weeks ago. The CCI 20 weekly has fallen to a positive 127.62 from a positive 185.16 last week. We await the return of the CCI 20 weekly to the plus or minus 50 range for another potential trade. Industry rotation, the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: gold and silver, REITs, and some tech on top. Oil services, retail, and brokers on the bottom. Bullish, semis continues in the top 5. REITs has left the bottom 5 and entered the top 5. Bearish, S&P retail continues in the bottom 5. Brokers has re-entered the bottom 5. Comp Tech, KBW Bank, and disk drives have left the top 5. Gold and silver has left the bottom 5, has entered and leads the top 5. Focus this week from www.zerohedge.com. How hedge funds closed out 2016 and why hopes for a 2017 rebound may disappoint, by Tyler Durden. The following are some key points and a chart. S2P market signal comment. We point out that rising or falling tides lift or lower all boats. This is, in fact, the reason we developed S2P market signal, viz. It is more fundamentally important to focus on market direction than focusing on cherry-picking entities that outperform it enough to make knowing direction irrelevant. Back to the article. 2016 was a year most hedge funds would be happy to forget. And while the same goes for 2015, 2014, 2013, 2012, 2011, and 2010, in fact, virtually every year since the financial crisis, in which the vast majority of the 2 and 20 crowd have failed to generate alpha. In recent weeks, there has been a fresh burst of hope that 2017 will be better for the HF community as a result of the recent collapse in cross-asset correlation. It is hoped that the resulting returns dispersion will make it easier for hedge funds to stand out in a world in which, due to central bank intervention, correlations had been abnormally high following the financial crisis. But is that an accurate description of events? To a great extent, the answer is no. While there are some notable exceptions, the rule generally is that as the market goes, so goes the average hedge fund, which is why some of the world's wealthiest billionaires are pleading that Trump does not disappoint and manages to keep pushing the S&P to ever higher records on nothing but hope of a fiscal stimulus, which may well never come. Equity-focused HF strategies, including equity market neutral and long-short, has decreased correlation to the S&P 500 compared to longer-term relationship, 3-year and 5-year. On the other hand, distressed credit, convertible arbitrage, and event-driven have increased positive correlation. Thank you for watching this week's Sand to Pearls Stock Market Commentary video featuring the proprietary Bull-Bear Point and Figure Market Breadth Summary Chart compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that your holidays were warm and rewarding, that you are looking forward to a prosperous and productive week and year coming up, and wishing you Happy New Year and true success.